In this video, we're going to continue talking about different types of ratios. So the first set we'll talk about here are referred to as debt ratios or solvency ratios. Financial leverage is a concept, right? It talks about how risk is magnified when you use fixed cost financing like debt and preferred stock. So financial leverage is a measure of riskiness of the company's choices on borrowing. Now, one of the things I will mention is I don't think you can say that debt is good or bad. I think you need to understand how to analyze the debt that a company has. So we're going to look at two different questions. One is referred to as the degree of indebtedness. This basically just answers how much debt do we have, right? So it looks at the amount of debt that the company has relative to other items on the balance sheet. Now, the other question we need to know, once we understand how much a company has, we then need to understand, can the company handle that amount of debt? There are companies that have huge amounts of debt and they have no problems making payments. There are also companies with a lot less debt and also struggle to make payments. So you need to answer both questions to be able to understand how well a company is actually making these decisions. So the three ratios we're going to concentrate on, the first is, there are four of them, I'm sorry. The debt ratio is total liabilities divided by total assets. It measures the proportion of assets financed by creditors. So again, how much of the assets, the left-hand side of the balance sheet that represents all the things that we've purchased, how much of that was purchased by the creditors? The other side of that coin then would be how much of that is purchased by the owners, right? They both answer the same questions. So the next ratio is the debt to equity ratio. Now this just looks at the relationship on the right-hand side of the balance sheet between how much debt we have relative to how much common stock equity we have. What is that relationship? Now, the debt ratio, since we have a balance sheet, right, both sides are balanced, the debt ratio must be less than 1 or less than 100%. However, the debt to equity ratio can be more than 100%, right? A company can have $1,000 worth of debt and $500 worth of equity. All that does is says, look, when the company is financing, when it's asking the questions of how it should gather funds, in a 2-to-1 relationship, it looks at borrowing more than what it uses of shareholder money. Now, the times interest earned ratio tells us about our ability to make payments, right? Sometimes it's also called the interest coverage ratio, but it's just EBIT, earnings before interest and taxes, divided by interest. Now, there is another ratio that's a little bit more difficult to get for companies, even from their financial statements. Most income statements don't break out lease payments. But so in this case, the fixed payment coverage, we want EBIT plus lease payments. It adds it back to that because lease payments are subtracted out. Now it divides out all the payments that are fixed. Interest, leases, and any principal repayments, any preferred stock payments, right? So again, this just looks at the ability to meet all of its fixed payment obligation. So the fixed payment coverage ratio. So let's look at the question of how much debt. So here we look, the debt ratio, that's the blue line here. We see that the debt ratio is in the ballpark consistently in the mid-70s. So Coca-Cola has chosen to buy its assets using about 70%, let's say 75% of financing from creditors to buy that debt. So it has a huge amount of debt. So that might also tell us the next line item, which is the debt equity ratio. And you can see here that the relationship between debt and equity is, I don't want to say very high, but it's certainly higher than what you might think, right? So it has a lot of debt relative to equity. So again, as I mentioned earlier, when they go to get money, they typically go and get more borrowed dollars than they use money from shareholders. Now the TIE ratio, or that interest coverage ratio, as you can see, it's well above 1, right? So we have more profit to cover interest. So paying our interest is not a problem. But you can also see that it has fallen recently. So we may want to explore why is that, right? Have we borrowed more money? Well, let's look and see. We can see that here that in general, the last 2 years, debt has decreased a little bit. So it's probably not that we borrowed more money. So something is going on that we would like to look at. Now, again, the company's not in trouble. They have 6 times more profit to pay their interest than what they need. But this is a question, right? This downward step here is very important for us. So again, let's continue on. And now we're going to talk about profitability ratios. Now, the first set of ratios we want to look at is what's referred to as common size income statements. These are statements that are converted into percentages of sales. So here's a picture, just kind of show you what we mean. Here's sales, and every line item that's in the income statement, you take that line item and you divide it by sales. So we can see here that the cost of goods as a percentage of sales in this last year, 39%, 39.7%, of every dollar of sales went to the cost of goods sold. If we go down a little bit further, interest expense, 4.1% of every dollar that came in the door went to cover interest expense. At the very bottom, we have net income. It's 25.3%. So what this says is every dollar that comes in the door, 25% of that goes to profits, ultimately goes to shareholders. So when we look at the ratios of the financial statement, there are a couple of primary ones that we're interested in. First is the gross profit margin. It's just gross profit, or the sales minus cost of goods sold, divided by sales. And this just tells us how well does the company control selling or production expenses. And of course, bigger numbers are better than smaller numbers. Operating profit margin takes another look. It looks at all of the costs of running the company. So the costs that are not incorporated are what are referred to as non-operating expenses. That is interest, taxes, right? Those things are not part of operations, so they're not included here. So how well does the company control the total expenses associated with operations? So again, if you're a line production manager, right, this is the number you're interested in. You want to understand what kind of profits are being generated from the operations of the company. The net profit margin, again, is the number that most people refer to. This measures the total amount of money that's available to common shareholders, right? This is, you subtract out all the expenses of the business, all the expenses of operations, but you also include the financing expenses, and taxation. So those have all been deducted. The challenge I personally have with net profit margin is that it's one of my accounting professors once referred to it as being muddy, right? It includes so much. It's difficult to understand how the company can fix profitability, net profit. How can you fix that? Can you change taxes? No. Can you right away change interest? No. So any changes have to come from operating profit. Any quick changes have to come from operating profit rather than net profit. So let's look at a picture here. Gross profit, operating profit, net profit margin. You can see that sometimes these numbers are fairly the same. We see they're fairly flat numbers. Now, profitability in general has increased dramatically. So something was going on in 2017 that they had very low net profit margin. Now, what was that? Well, if you look, operating profit was down a little bit, but it wasn't production. So something happened here in operating profit, but goodness, there was a huge drop. So there were some other expenses going on in 2017 that had nothing to do with running the company. Again, without looking at the financial statements and exploring further, we really don't know what that is. So now let's look at some other profitability ratios. Earnings per share measures the overall profitability. It is that net income divided by the number of shares outstanding. And this represents the number of dollars earned for each share of stock of the company. Now, return on total assets is earnings available to common shareholders divided by total assets, net income divided by total assets. Now, this measures the effectiveness in management and generating profits with its available assets. Sometimes we refer to this as ROI. Now, the challenge with this ratio, though, is it's very difficult to make comparisons. If the company changes its financial mix, right? Because remember, the difference between net income and EBIT is interest and taxation. So if the company increases its financing dramatically, its debt financing, then EBIT is not going to change, but earnings available will drop dramatically. So if we want to make comparisons and really understand how we relate operations to assets, a better number is what they refer to as basic earning power. Again, it's not influenced by financing decisions of the firm. Return on equity, again, is a bottom line kind of number. What is the net income of the company divided by the number of shares? And again, this measures how much return goes to or belongs to the common stockholders of the company. So let's kind of look at these ratios. BEP we have first, right? EBIT divided by total assets. Here's return on assets, return on equity. You can see here the BEP is the blue line, and it's very similar to ROA. Again, the difference, though, is interest and taxation. We can see that, again, the lines are fairly stable. Return on equity, though, has grown substantially. Well, what could do that? What could cause ROE to increase? Well, if you look at it, the only thing, either net income went up or net worth went down, right? That's what the ratio says. There's a challenge with that, is to understand, what is actually causing this to happen? How are managers causing this to happen? So I'm sorry, I kind of bounced around trying to get to a point here. Very difficult to understand the importance of that one particular ratio. So let's look at how we can analyze this a little bit better. there is a technique called the Dupont Equation or the Dupont formula. And it's a way that we can calculate ROE and understand the managerial decisions that impact it. So how can we do, again, let's go through the math first and we'll come back. So we have net income divided by sales. That's the profitability margin. If you multiply this ratio by this ratio, which is sales divided by total assets, again, this is efficiency, the sales divide out. So now we have net income divided by total assets, which is really return on assets. Now, if you multiply that by total assets divided by equity, right, total assets divides out, which then gives us net income divided by equity, which is return on equity. So the question is, what do these things tell us, right? The first thing it talks about is profitability. If you want to increase return on equity, you need to increase profitability. If you want to increase return on equity, one of the things you can do is try to increase efficiency, total asset turnover. If you want to increase return on equity, one of the things you can do is increase financing. If you remember, I talked about the debt ratio is total debt divided by total assets. This is just an inverse of that. This measures it relative to buying or assets with equity. But a bigger number here represents leverage and increased insolvency potential. So again, if you multiply these numbers together, we can understand how ROE works. So let's see what's happening. Again, we know in year one here, there was some strange things going on in profitability. But the next ratios, we can see that in general, what? There's been a little bit of an increase in net profit margin. So that should be an indicator that we should see return on equity going up. If you look at efficiency, we've been pretty consistent, but it's had a little bit of an increase, but pretty consistent, not much change there. So if you look at ROA, it would have been nice if I had more decimal points here, but the number is pretty consistent, 8, 10, 9%. And then the difference here, financial leverage multiplier, you can see it's been pretty steady, but it's been kind of declining. 4.63, now it's down to 3.8. So leverage has been going down. So these numbers are going up a little bit or staying the same. This number is going down. The outcome is we've been seeing fairly steady types of return on equity, but certainly from these 2 years, things have increased dramatically, right? So that again is the idea or the concept of profitability ratios for a company. So let's go ahead and we're going to end this video here, and I look forward to seeing you the next time.